Gareth Soloway is back. He is a chief market strategist at verifiedinvesting.com. Let's revisit what he said last time on the show regarding gold, China, the stock markets. China is very important, very hot right now. Massive stimulus going on there. How would it affect the rest of the world? The Fed pivot. We haven't talked to Gareth about that. What's his outlook on the markets following a 50 basis point cut? Did it surprise him? We'll find out. Welcome back to the show, Gareth.
Hey, thank you, David. So good to be back with you.
Good to be back with you. As always, the markets have been ripping higher ever since 2 weeks ago. The Fed issued a 50 basis point cut. Did that surprise you? And more broadly speaking, anything in the last month of trading that really surprised you?
Yeah, so one of the things that I've picked up on, and remember, I'm a trader, so I'm literally immersed in the market 24/7 almost, looking for these weird kind of discrepancies. And one of the things that caught me by surprise and kind of was an outlier was that after the Fed cut 50 basis points, we saw the markets initially sell off. And the idea being is that, wow, why is the Fed cutting 50 basis points if everything is okay? What is freaking them out that's causing them to cut by 50 basis points? But then what we saw is after the market sold off that night, there was this big media push led by, in my opinion, the institutions to change the narrative going into the next day and say, wow, the Fed cut by 50 basis points. This kills any chance of a recession. And before you knew it, the retail investor was lured back in with a big gap up the next day. Now, this is super, super important. If you look at the market since then, most days have been gap ups and the markets have sold for the first hour to 2 hours in the day. Well, why is that happening? Well, as a trader, I know that institutions use that exit liquidity of the retail investor coming into the market early in the day when there's most volume and they're selling. So they're pushing the markets up overnight and then dumping into the retail investor. To me, this narrative push, this kind of urgent kind of, hey, we got to keep the markets up so we have exit liquidity. To me, it's showing important worries by the institutional money. Investors need to be aware of this.
Okay, I like to flip over to my screen, and then just show you this chart real quick. This is quarterly financial reports. U.S. corporations total cash on hand and in U.S. banks. This is how much cash is reported by U.S. corporations here, and we're looking at, according to data from the St. Louis Fed, that they collected over $270 trillion is millions of dollars here, of or is that billion? Yeah, $270 billion, 270 trillion. What am I talking about, Gareth? $270 billion of cash. Anyway, the point I'm trying to make is that the amount of cash that they've been holding, corporations on hand, has been declining. And so up until 2021, it was kind of correlated with the stock markets. As you see, the stock markets also peaked back then around 2021. However, the stock markets have been ripping ever higher ever since. Well, I guess companies have been deploying their cash. What do you make of this trend?
Yeah, so there's two things that when I see this trend that it makes me very aware of. Number one is companies are having to spend more money to keep that revenue flow coming in, right? When everyone had a ton of money during COVID, they almost had to spend no money to generate revenue from sales of products, goods, and services, right? But now they're seeing that they're having to push that money and spend that money on advertising or whatever else it may be to bring that money in. The other thing I think that's going on is you're seeing a lot of spend to keep themselves on the cutting edge via the AI, right? So you have AI becoming very, very big, and therefore these companies are needing to buy these chips. They're very expensive, and that's running down their balance sheets in terms of cash as well. So again, two-pronged, but overall, it's an economic worry when these companies have to spend a lot more money to generate the same amount of revenue that expectations were at.
Do you think that corporate earnings into the next quarter will be higher or lower than currently?
Yeah, so I would say this is that overall you're looking at corporate earnings in decline. I think that again you're still going to probably get a beat in this quarter, but my guess is we're going to see that corporate earnings are starting to slow. We've seen warnings from the likes of McDonald's, from Disney, from a lot of these companies. And really, we've seen the AI companies that have been helping keep the market up. But even those are starting to stall. In fact, today, looking at the AI stocks, the chip stocks are under a little bit of pressure. So you have price to perfection stocks, valuations that honestly are stretched in any market condition, even in a bull market. And I think that's going to be a hindrance for valuation. So I would look for slowing to flat growth in earnings and eventually a decline in the coming quarters.
Are you liking the video so far? Well, before we continue, let me tell you about an innovative way to create videos, which I can tell you from personal experience can be challenging and time consuming. Today's sponsor, InVideo AI, makes the process incredibly simple. Whether you are a content creator, marketer, or business owner, InVideo AI transforms your ideas into polished, professional quality videos in just minutes. It's the world's most used AI video creator with over 10 million users across 150 plus countries. All you need to do is type out a text prompt. From there, you can get creative and fine tuned ideas for your videos using just text commands. It's like having your own video editor on standby. And the best part, you can clone your voice and make it narrate the videos in your own voice in any language. It does the job of more than 10 tools packed into one and costs just $20 a month to start with. Scan the QR code on the screen here or use my code linked down below to get 2 times the video generation credits in your first month. Okay. Are you looking for a specific sector outperformance? Take a look at my screen one more time, and then I'll let you flip over to your screen. This is the S&P 500, and like I talked to you offline, we have a few sectors that have been kind of outperforming. Let's take a look at. Let's do. Let's do well. First of all, financials. Okay, financials hasn't outperformed, but I just want to show you something here. If you just take a look at it from a percentage scale, year to date, financials have been pretty much following the S&P 500. How do you feel about financials and banks in a declining interest rate environment? Typically, in a rising interest rate environment, which is what we've seen in the last basically up until COVID, financials have done very well because as interest rates rise, they're able to expand their margins. How do you feel about banks and financial stocks following what the Fed did 2 weeks ago, which is cut rates, and then we're going to talk about more rate cuts later down the line?
Yeah. So I think there's two ways to take this. And the main one is that as interest rates come down, their net interest margin is going to drop. So that makes them less profitable. Now, the concept is that, hey, listen, more people will come and look for loans, which is a positive because more money loaned out could mean more income or revenue for these banks. So they kind of cancel each other out. But the big key is if the economy is slowing and we're seeing delinquency rates starting to pop, we're seeing credit card problems, delinquencies 90 days or more at multi-year highs. All of these type of things are warning signs that are not good for the bank. So you have obviously net interest margin coming down. That's not a good thing. Then you have the positive, hey, listen, cheaper money, maybe more people borrow. Those again cancel each other out. But then you have the slowing economy. And if people stop paying their loans, like I think is going to happen here over the next 6 to 12 months, that is going to bring these stocks down. And if I can show my screen now, I want to show you this chart of JP Morgan Chase. This is a very bearish chart. It's what we call a channel pattern. Notice this line is parallel with this line. It's kept JP Morgan bouncing up and down inside of it. The problem is that you're at the low end. In fact, we opened lower. We got a bounce today. If this line breaks, this is a major technical breakdown on the chart of JPM. And it would honestly probably bring JP Morgan back to about $173 per share. If that happens, that's a major drop for this bank. And I do think that there are going to be problems coming up. And also, let's not forget, guys, we also have a commercial real estate market that's in tatters. We have a slowing financial housing market that's starting to slow. There's lots of things here that could pose problems for banks and their balance sheets.
Wait a minute. Sorry, can you go back to your JP Morgan chart for just a minute? I just want to ask you about how to read that chart and
Absolutely.
how to
All
read
right.
charts in general. So, yeah, you mentioned that it's showing a bearish pattern. If it breaks below that lower bound of that range, it could go much lower. I just want to point out that it happened the last cycle. It went below that channel, and then right in August, right there, right there. You see, it went
Yep.
below that channel, but it still went back up. What happened there? What was different that time?
So what's different there that time is you hadn't had the rate cuts. You don't have the weaker economic data, right? So, and look at how you just went briefly below it and then recaptured it. So this is
Okay.
what I would call an unconfirmed breakdown. And so to confirm a breakdown, what you need to see is you need to see a close below and a subsequent day that closes below that low. Notice we didn't get that. That's what I call a confirming move. So what we're looking for here is a close below over in this range. Let's say it closes here. and then you need a secondary day that closes below that low. That's a confirmed breakdown, and that would signal the probability is at 80% or greater that we then end up going sharply lower. But again, that did not happen here, and that's very important. And good point to bring that up so I can teach that.
Okay, so how much lower below the channel does it have to go before you can say that it's a confirmed breakout to the downside?
Yeah, so it's not a matter of how much further below, it's a matter of subsequent closes. So you could literally close, let's say 30 cents below this line. If the next day closes below the low of that previous day, it is a confirmed breakdown. And the thought process is very simple here, guys. So let me explain. And this is something that I've created on my own. It's called the confirmation signal. It essentially allows us to know when institutions are not playing games. So oftentimes institutions know these levels. They'll push it below to get all the weak-handed longs to flush out, exit the position. They kind of flush out the weak hands, as we say, and then they bring it in the opposite direction. Institutional money only wants to risk so much of their money. When you confirm a move, whether it's a breakout or a breakdown, there's too much money required to keep or reverse that move. And institutions generally, probability wise, won't be looking to fight that move. And that's the key there. But one day down, absolutely. They love those games. They play it every single day. I've had a hedge fund. I've worked in hedge funds. I've consulted with hedge funds. These are classic games that I always like to reveal to the retail investors of what goes on.
Gareth, let me show you my screen. I just want to point out sector outperformance one more time here. So let's remove the financials. Let's replace that with global consumer staples ETF here. So over the last 5 years, it's underperformed because of the tech boom. If you just take a look at year to date, also underperformed. If you start taking a look at it 3 months, however, in the last 3 months, the consumer staples sector has started to outperform. Okay. And consumer staples, as you know, is a very defensive play. People usually go into the staples if they think that there's going to be some sort of slowdown or they need to get defensive and buy something safe and stable. During a recession, people spend more money on consumer staples stocks and products like, they go to Walmart more, Dollarama more, and so forth. Utilities as well, another defensive sector. Let's take a look at XLU. Okay, XLU has greatly outperformed the S&P in the last 3 months. What is going on here?
Yeah, so in general, you don't have mom and pops putting their money in utilities. This is more what big money does. Smaller money, retail money wants to make the big score. They're going to go into names like Nvidia. That's why they buy the top. The hype gets the most there. So what you're seeing is that when utilities outperform, it's really bigger money, institutional money, or large investors that are going there for safety. And I think the large investors, the institutional money, they have the best insights and the best information. They can pay for that information. They are clients of Goldman Sachs, for instance, who is giving them information, right? When you have 100 million or 50 million at a institutional firm, they're going to be sure that they're taking very good care of you to keep your business. And so when I see that outperformance, it's a warning sign that something is up. What's kind of crazy is that money has come out of names like Nvidia. We're not at all-time highs on Nvidia because those companies have gotten so big with trillion-dollar, multi-trillion-dollar valuations. When money comes out of those names and goes into these other names like a Walmart or other names, it ends up pushing these stocks to ridiculous levels. Like, for instance, if we look at Walmart here, I got to show you guys this because this is just incredible. Walmart is trading at a 40 forward PE ratio. Historically, that is unheard of, but money has come out of these high cap tech names and gone in here, and it's pushed up Walmart so much. Now, granted, Walmart's a defensive name, right? When people struggle, they go down from some of the higher end, grocery stores and retailers to a Walmart. So Walmart's been a recipient, but on a valuation basis, this is nuts to see these valuations. And this is where we get into China, where other areas of the world eventually will see money flow out of the US, as you can't justify, at least for me. I actually have puts on Walmart up here because it is so overbought on a historical metric. So again, look for that, folks. Look for these kind of rotations even out of US stocks as the economy continues to slow. And I know I say slowing economy. Well, what is slowing economy? Well, for those of us that really look at the data, and I know a lot of your viewers are smart, they look at the data. There is no doubt. When you see revisions in the jobs numbers of 800,000 from what was reported last year, when you see the unemployment rate starting to push up, when you have You have names like Disney saying, hey, the consumer's not spending. Heck, we heard from Stellantis today that the cars, they're actually looking to cut back on the amount of cars that are getting sold because, or at least going into showrooms, because the consumer is not going out. So the consumer is starting to hurt. It's a trailing reaction. Eventually, we're going to see that reflected in a recession.
Okay, but I just want to point out that if you think there's going to be a recession, or a recession may come in the next quarter or two, why would you put puts on Walmart, a stock that basically has beaten every single recession since, except I think one in the early 80s when there was a company problem. But anyway, Walmart is known for being one
So,
of those stocks that is
right.
just recession proof.
And that's one of the reasons why I love it as a short, right? As a put place is because when everyone knows that that is the place to be, money flows in there. When you look at Walmart's, let's go to the weekly chart. Like this is a move on Walmart from in 2022. This was a $40 stock. It's now 100% higher, trading at a 40 valuation, 40 forward PE. That is not a normal PE. Are you going to get growth like Nvidia? Like think about this. Walmart's trading at the PE multiple of a Microsoft, a Meta. Actually, Meta's at 25. So it's way over that. It's not a growth stock, but because money has chased it, it's gone to these valuations. So my prediction is that when you see this economy slow down, it's not just going to be the big cap tech that are selling off. There's actually going to be sell-offs in these names as well. As even when a consumer spending slows down, it's going to eventually hurt Walmart.
Okay. Last three times we had a Fed pivot, though, we had some sort of economic catastrophe. COVID, uh,
Mm-hmm.
2020, and then 2008 was Lehman collapse, great financial crisis. In 2001, they cut by 50 basis points during the tech bubble bust. Right now, nothing bad or of that scale is happening, and yet they still cut 50 basis points.
Yes.
Maybe this time really is different. What do you think?
Yeah, and that's kind of my point, guys, is that, just a couple days ago, the markets were favoring via the Fed watch tool another 50 basis point cut in November. That would be 100 basis points in two consecutive meetings. Yet somehow the spin being put out there in the media is hey, this is actually great because it means there's no chance of recession. Guys, the Fed is not crazy. They are not cutting that much because everything is okay. If they thought it was going to be a perfect landing, they would do 25 basis points a couple times, then wait a little bit, make sure inflation's not roaring back. They are concerned. Now, the narrative is being spun away from that. Don't get fooled by that spin.
What do you think is going to happen to the Fed funds rate going into 2025, the middle of 2025? If you just take a look at the CME Fed Watch tool, for example, do you have that up, or maybe I can show
No,
it?
yeah, if you want to show it, I want to show the 10-year yield chart
Okay,
afterwards.
all right. Let me pull up the Fed funds futures here. Fed Watch tool. Right now we're looking. Right now we're in November. Let's flip over to June. No, let's do July. Okay, let's do like middle of summer next year. We're looking at a significant probability, or a big, most of the probability lies in the 275 basis point to 325 distribution. Okay, so right now, the current target is 475 to 500. So we're looking at exactly a 200 basis point cut from today in the next year or so. Now, do you think that is a little bit aggressive given that the Fed is projecting three and a quarter, 3.4 is their median dot plot expectation? I know some economists don't think the dot plot is reliable when forecasting, but that is what Powell said. So, what do you
Yep.
think about this expectation?
Yeah, so I also agree. I think it's very unreliable. I think that for the most part, the markets cue off of what the Fed says, and then they obviously extrapolate out. But to me, you're looking at an economy that is going to slowly weaken, right? If we look at the various metrics here, we have the yield curve has now uninverted. If you look at the yield curve, what happens? It uninverts 3 to 6 months later. We have a recession, and that's been historically the norm. Pretty much, even going into COVID, it was briefly inverted just before COVID hit. And so we have to say that, okay, by the end of this year to the first quarter of 2025, that's when your recession hits if you go by the data. And it's very important to go by the data. In addition, if we take a look here, and if I could show my chart, I want to show you the
Yeah,
10-year yield.
yeah.
Look at what we have on this. It's fantastic. So we have gone to a point where we are now coming down on the 10-year, and I have major technical support. Look at this high here, right through these lows, this upsloping trend line. These are merging around 3 to 3.25%. So for me, I'm looking at this is where the Fed funds levels are going to be, where we're going to come down to on interest rates. Now, that kind of puts it in the range, but still, the key to understand here is that we're likely going to see a recession. The Fed is going to want to cut more, but I'm fearful that if they cut too much, it's going to kickstart the inflation gauge again. And I am worried about stagflation. I do think stagflation is a very possible outcome here, not in the near term. No one's going to talk about it for a little while here because we've seen the numbers come down on inflation. PCE came down, CPI's come down. But I do worry that the Fed being so aggressive on these cuts, you're going to see inflation start to move up, but you're not going to see the economic growth that you're hoping to get.
Why would we have inflation move up if the consumer spending is going to slow down, like you said earlier?
Yeah, so number one, we have to look back to the 70s when this happened, right? So in the 70s, that was the last time you saw this kind of stagflation type of focus, where we did see inflation moving up even when the economy was slowing. And my fear is this, is that you're getting to a point where the debt is going to start to matter. So you have 33 trillion, 30 whatever it is trillion dollars in debt now for the US government. The Fed, at some point when we get in a recession, they're going to start to make money even easier. And I do worry that these implications are going to force inflation to uptick just a little bit, which is going to basically hogtie the Federal Reserve from continuing to lower rates back to where everyone's hoping. And, mortgage players and interest rates, the thought process is, hey, they could go back to where COVID was, at zero or just around those areas. I don't see that happening. And I do worry that that's going to be the outcome here. We're going to see interest rates coming down, but stopping because inflation begins to kick up again. And then you have a weak economy that can't be stimulated out because inflation is starting to push up.
You think maybe the market is anticipating lower inflation into next year because the Fed funds rate futures is projecting a much lower Fed funds rate?
And I think that's right. I think the market is even thinking about, well, maybe we'll go into deflation, right? Because if you look at the PCE data, it's coming down so quickly that, heck, it could be deflationary. I don't buy that. I think we get lower to 2% on inflation. It starts to become stagnant. The Fed starts cutting even more because the economy slows, and that starts to kickstart inflation again, even with a slowing economy.
So what's your outlook for the 10-year yield going to 2025?
Yeah, so right now the 10-year yield looking like that 3% to 3.25% level. I think that's going to be the key zone right in here. So you're looking at this as being your first major technical support. If it breaks that, then things get really nasty. And what we could look at here is, if we zoom out on this chart on the 10-year and go back to 1995, there's a really amazing trend line here. This would be kind of a worst case scenario for yields in terms of downside. Notice again, you have a level here where we take this high, this high, this high, and right through here. And that would be your next target zone of a move to the downside that would take us below. So this is your first target. And then if that breaks, you get here. But I don't anticipate it getting that low. Again, that would be around 2%. That would be kind of a worst case scenario. And I think we'd have to be in a pretty bad recession and not see that inflationary pressure to get yields that low.
Okay. Well, that means, would you be bullish on bonds then? If you think
so I think it's a safety hedge. You have to be bullish on gold. You have to be bullish on bonds. You have to basically look for these places. Like when you have utilities doing well and defensive names, if the economy starts to tank and we do see any sort of sell-offs in the Walmarts, the money is not going to necessarily choose tech stocks. It's going to still have to be invested, but likely heading to other areas like bonds and gold.
Well, by the way, let's talk about gold for just a minute. Earlier in the year, you're on the show, you had called for a higher gold price. I believe you said $2,500 could have been the target. I think at the time it was $2,000 or $500 move on $2,000 seemed like a pretty big deal at the time. 25% is not common for a year for gold. It surpassed that. We're almost at 260, 2655 is my latest reading. 2,700. We're close to that level. Is this overbought for you?
Yes, short term it is. And in fact, I'm short gold right now. Now, please understand, everyone watching at home, I was a bull at the start of the year when we were at 2000 on your show. In fact, I said, hey, guys, my target is $2,530. We've gotten there and even gone past it per the analysis. And that was a beautiful trade. Like you said, I was called crazy. People said, hey, gold is over with. No one wants to be in gold anymore. I love buying things when people say that. So check this out. We have the chart of gold. I'm using a logarithmic chart again. So we look at the logarithmic. We look back to the 1980 high. We connect that to the 2007 bull market high and look at what we just tagged on gold. So for me, as a shorter term trade, I'm short gold here for a pullback to 2,500, at which point I plan to flip it over as my mid to long term remains bullish to 3,000 being hit next year in 2025. So 3,000 target next year, but in the short term, I'm expecting a pullback. And we've actually started to see it. If we flip over to our daily chart, you can see right into that level. Look at that. Beautiful how the charts just work their magic. We're starting to see a pullback. Here's your target zone right here. This is around 2,500. We can see how this was kind of a shelf right here. Then it broke out. We should retrace right back into that level before the next bull move comes in.
Are you looking at potentially $3,000 soon?
Yeah, so I think I don't think it'll be until 2025, probably
Okay.
mid to late 2025. But yeah, there's really no reason why gold will not go up unless Elon Musk starts mining on asteroids in the near term. That's the only way I would get bearish on gold, because we have to remember that you have debt in the political system, right? The U.S. debt just keeps going up. There's not one candidate for president that's even talking about reducing spending. And remember, when you have a great economy, that's when governments are supposed to pay down the debt because they're bringing in more tax revenue. Instead, our government really for a long time now has just been spending, spending, spending. The problem is if we go into a recession, like I think, they're going to need to spend even more to stimulate us out of that recession. I don't even know if it's going to be possible, but you can't go into fiscal austerity when you have a recession. I mean, that's just going to make us go into a depression. And so that debt is going to keep going up. And that's going to make gold a valuable asset to diversify away. And by the way, Bitcoin too, I just think with Bitcoin being correlated to the stock market, you probably run the risk of 20-30% corrections that could bring it much, much lower before you have that next up move.
Okay, I'm just going to ask this next question to kind of challenge the way we look at things right now. Right now, our base case assumption is that at some point we're going to enter a recession, maybe in the next year, correct? So
Right.
what if we're wrong about that recession assumption? What if things start to improve and you look at the data and you say, hey, I think actually things are going to be on an uptrend continuously. There's going to be no landing or perhaps even just a soft landing, which by definition is kind of a mini recession. But anyway, let's say no landing or soft landing. How would your trades change in that scenario?
So interestingly enough, and this is really fascinating, is if we get a soft or no landing scenario, which is what the Fed has projected and what many economists have said, well, then it's still very problematic for tech stocks because interest rates won't keep dropping. And even small caps, I mean, the Russell, right? The Russell is trying to push to its all-time highs, hasn't made an all-time high since 2021. But if interest rates are going to stop going down because the economy starts to rev again, well, number one, you're going to get inflation. All right. And that's going to be the kicker right there. Do we start to see inflation spiking again? And number two is the Fed's going to have to stop cutting rates, which the market is addicted to that cheap money. And so it really works both ways. I mean, if we go into a recession, you have valuations because of an earnings recession coming down. And if we have a good economy and interest rates can't fall anymore, the Fed doesn't cut, then you also have that taken away from the markets, the cheap money, and stocks fall. So either way, to me, I'm seeing this market in a very tough conundrum for why this market could continue to go up significantly over the next 6 to 12 months.
So before we talk about China, let's close off on the U.S. on your
Mhm.
S&P outlook here. I don't think we got your year end or short term outlook yet. It's been on an uptrend the last couple of months. Do we think we can get six? Do we think we can get 6,000 by the end of the year?
So that is absolutely on the table. It's only about 5% away at this point. And I want people to understand is that there's a very clear indication going back to what I started the interview and talking about this narratives, the narrative that the institutional money is feeding to the CNBCs, the Bloombergs, et cetera, is that this is everything that happens, even if it's kind of negative, like a 50 basis point cut. Why is the Fed doing this? Why do they feel the need to do this? Oh, but don't worry, it makes it no chance of a recession. That's the narrative that's being spun. That tells me that the institutions still need this market to potentially go up a little bit more, maybe touching the even number of 6,000 to get the rest of these kind of sideline money in the market and be able to exit liquidity or use that as exit liquidity. So I don't think we go past 6,000, but is it possible we could touch 6,000 before the big rollover occurs? Absolutely. Don't underestimate the need for that exit liquidity to lure the retail investor in.
So bottom line, short term momentum is still to the upside, and you're expecting new all time highs.
Yeah, so it's tough to say I'm expecting it. I'm just open to that possibility. So net, if you look at my positions in my personal portfolio, I am short, and I'm pretty heavily short at this point. But am I okay understanding that we could push up 5% more and touch 6,000 before rollover? Absolutely, that's fine with me, because I think the rollover, when it comes, will make August look like a small dip in the markets, and I think we'll break those August lows and go much lower.
Do you ever play with options, by the way, to straddle positions and get both sides, get both
I
directions?
So I don't do straddles. I'm not sophisticated enough in the options market to know those and feel comfortable. But what I have done is I've taken positions in certain equities that on the put side where I think there's a lot of downside. So I mentioned Walmart is one of my put options right now. My biggest put option right now, which I buy 1 year out. So just to give people ideas, a lot of people play these zero day options. Way too risky. It's a total gamble for me. I don't play it. I give myself a full year on my options just in case my timing is off, which my timing is off from time to time. Everyone's is. But basically, I have Meta puts on this market. I have Walmart puts. I have RCL Royal Caribbean, all-time highs on that stock. And if I am right that the economy is slowing, that should pay out really nicely. But yes, to answer your question, I do play with options, but not the strategies.
Any stocks or sectors you're long on?
Yeah, so there are stocks I like. Celsius, so beaten down names that have a lot of technical support. I can show my screen here again.
Yeah.
Celsius is into a massive area of support right down here. If we flip back to the regular chart from logarithmic, look at these two trend lines right in this range. So a lot of support on Celsius. I like that one. I've been long WBA. This one, to me, look at this beautiful wedge pattern. We're borderline getting ready to break out. So for me, looking at interest rates probably coming down another 100 basis points over the next 6 months, let's say, and that maybe is a conservative cut. I think that names that have a lot of debt that have been beaten down, like this Walgreens, there is an opportunity on a swing trade basis to make 20-30% of upside here in the near term over the next 3 months or so.
Okay, let's finish off on China now. We don't have time to cover the dollar and Bitcoin today, but let's do that next
Going to
time.
break people's heart if we don't cover Bitcoin.
Okay, you know what? We'll do Bitcoin.
We'll keep it fast,
We'll
snippy.
fit that into the agenda. No rush. I know the people want Bitcoin. You're right, but let's look at my screen first. China launches late stimulus push to meet 2024 growth target. Um, by the way, you had called the China rally earlier this year, but it wasn't what you told me before. It wasn't based on the fact that you expect stimulus. It was just on a valuations basis. But take a look at what happened. Their central bank announced last week that they would lower rates, and they announced a bunch more fiscal stimulus packages. They also cut rates on lending for the housing market. They were facing deflationary pressures, like this article from Reuters said, and now this is the most massive stimulus package since 2008. And look what the stock markets did. Uh, China stocks surged in biggest single day rally since 2008 on stimulus. So Chinese stocks soared to their biggest single day gain in 16 years on Monday, with domestic Asians registering their highest ever turnover. CSI 300 blue chip index is now up nearly 30% from its February trough. So it says here, by some definitions, this may be in a bull market. Okay, let's talk about China here. How do you feel about this stimulus? Are you reversing your long after this rally?
So this is the kicker, right? So remember, this is one of the markets that I was so bullish on. If we look at my chart, this is the Hang Seng stock market. This is one of my favorite type of chart setups where you get these V bottoms right here, right? So V bottom right here, and then we see this long consolidation where from that high, you take that high right there and this low, and notice how we never violated the low, even after literally a year and a half to 2 years. That is an unbelievable bullish technical chart setup. In addition, this is the kicker, right? So one of the reasons on the last couple shows that I've been on with you is I've said, hey guys, you got to be buyers of China. Is number one, the valuations were incredible. 8 PEs. I mean, we've talked about these mega caps here in the US, 30, 40 PEs for forward numbers. China's some of their best companies, Baidu, Alibaba, Tencent, trading at 8 forward PEs. Now, when do you buy stocks? Do you buy stocks when they're at all-time highs or when there's blood in the street? Well, we all hear that about that, but people are usually too scared to buy China when there's blood in the street. That was your time right there. I loved it. And then I'm a big fan of certain hedge fund players. David Tepper, hugely long. I talked about that recently. Michael Burry, we all know who Michael Burry is at this point. He was hugely long or went into this. When you see the big money, the smart money, the top 1% of institutional players getting in on China long, you can't ignore it. And you got to jump on board. So I was on board. We had Alibaba, Baidu, IQ. I mean, just amazing opportunities here.
Let's close off that on Bitcoin. So you like China still? Do you like Bitcoin?
Yeah. So, and just to be clear on China, I'm short right now, but that's a real quick trade. I'm trying to capture the alpha back to the downside, a retrace. China's gone up insane, like JD.com up 60% in 2 weeks. Insane. So I'm a swing trader. I'm short, boom, and then I'm going to flip it long for the bigger macro long on China in the coming months. All right. So I always
How
like
much
to.
lower would it need to go before you flip back to long?
Oh, not that much. I mean, like basically, you give me a 10 to 15% corrective move. If we look at JD.com here, I want to show this chart real quick. So JD again up 60% just in a straight line over the last week and a half or so. You just do a standard Fibonacci retrace here. We look at this. I would say right here, the 50% retrace of this move. So back down around $34, $35. I start going long again. So just run your mill correction. You can see it's already selling off pretty tremendously here. And again, that'll be what we look for there.
Okay. The Bitcoin price has been selling off though, and this is kind of strange because historically it's been tracking the Nasdaq, but it's just been diverging in the last basically week or so. But I'll let you comment on that. Yeah.
Yeah. So, and what we're seeing here, guys, is Bitcoin right in front of you. And so Bitcoin has been tracking the equity markets very, very closely. Today, we are seeing a little weakness, but a bigger sell off in Bitcoin. This concerns me because, again, this should be the market where Bitcoin's making new all time highs, with the stock market making new all time highs. So, while this bigger channel is a bullish channel, the key again is, if the market's dumped, does it come back in here? I would say that as long as you hold 50 to 49,000, this support number 1 and 2 here, you buy these levels. If this breaks, stop out right away, because I honestly think if this stock market collapses, you're going to go a lot lower. We could be talking even into the low 30,000 range. I will be a heavy buyer in the 30,000 range, though, if we get there. Again, I love Bitcoin long-term, mid-term. It's just the stock market dependency is very concerning to me because people are fickle, right? You have these new ETFs, spot ETFs, lots of retail investors that really weren't in Bitcoin prior are in. If they get scared, they dump and Bitcoin goes down.
Wait, sorry. Why would it go to 30,000 from this point? That's a 50% decline.
Yep. So number one, 50% corrections in Bitcoin are standard. That's standard for bear markets. If it goes into a bear market flush, 50% is pretty much your run of the mill. But the key is I'm a technical trader. So if we look at this level right here, the 52 to 49,000 level, if those break, there's not a lot of major support until the low 30s. So this level must hold if you're bull case. If you're a bull right now and you see Bitcoin dumping out to the low 50s, it's got to hold that. If it breaks, watch out below.
What about to the upside? Is there a ceiling where if it breaks above that, we're in a bull market?
Yes. So see this upper resistance line right here, this parallel line. So if price can get above there and confirm, you're probably headed to 100,000.
Sorry, where's that again? 70,000?
Right. So basically 69, 68,000. If you get above there, I think money just flocks in and it rips higher. And I think within three to 4 months, you could be at 100K.
Okay, I'm curious as to why Bitcoin, just based on the charts, did not sustain its pre all-time high, which is earlier in the year. It reached 70,000, which beat the last all-time high a couple of years ago, and it just stalled there.
Yeah, it's a great question. Great question. And I think this is where people are. So one of the things to keep in mind is that we've seen utilities, you were mentioning it earlier. We've seen defensive names start to take off and run. Well, Bitcoin is probably the least defensive name out there of an asset class, crypto, right? And so I think that's why Bitcoin has struggled, is because even though tech stocks and the markets are making new all-time highs, the markets are not being led by, Microsoft or Nvidia anymore, right? They're being led by the Walmarts, like you said, Walmart, Costco, Eli Lilly. Like these are much more defensive names, and that doesn't jive with investing in Bitcoin. And so I think Bitcoin has seen some money move away from it for defensive names, and that's kept it from making new all-time highs here in the short term.
let's close off here. That was a lot covered today.
That was a
Good
lot.
stuff, Gareth. Where can we learn about you?
Just come check out verifiedinvesting.com. I truly want to give verifiedinvesting.com the ability for retail investors to learn all the tricks that institutions love to play, all the tactics, all the technical analysis. I essentially want it to be the place where the playing field gets evened out for retail to give us all a shot to make money in any type of market, both long or short. No narratives, just data, just chart analysis. It is what it is. Doesn't matter if I like it or not, or you like it or not. Charts are charts. They are unbiased.
Let's follow up soon and talk more. Thanks very much, Gareth.
Thank you so much, David. Take care.
And thank you for watching. Don't forget to like and subscribe.